All right. Good morning, everybody. It's Wednesday, hump day. Green on the screen around the world. Hong Kong, however, is down 0.5%. That'll be those China ADRs in emerging markets. The Russell is the closest to that at 0.04%. It's really just flat. Dow behind that, and the NASDAQ almost at 0.25%. We got a whole lot of nothing, which makes perfect sense. We're really high above the zero gamma level. It's supposed to be tight ranges, when you're up there like that. And of course, we're waiting on Powell, and we have PPI data today. So I think by now everybody's kind of prepared for the idea that, the market really brought forward a lot of the Fed's cuts already. They've already priced in 4 of these 5 cuts for next year. That's some extreme numbers. So we're going to get PPI and then Powell. And that'll be a wrap. It seems recently, we usually go into this with a hurry up and wait mode. But the last few FOMCs, we've actually grinded a bit higher or lower before the event itself. So I'm not a big fan of the idea of just believing, it's going to be sideways. It could be a grind up or a grind down. And that makes it a threat if you're going to try to do, like a half-day butterfly or half-day iron condor or something like that. There's a bit more risk there than you would believe, because we have, in the last few meetings, tended to grind higher and lower. As we would expect, high anticipation impact, high volatility on a day like this. Levels are not really going to be of value on a day like this. They will until the event, right? But once we get Powell, it's not going to matter where yesterday's high or low is, right? It's not going to matter where the Globex open or today's RTH. Price is going to punch right through all of that. So, really keep that in mind. On events, those levels have no weight or bearing on the market. It's just going to move. It's all about flows. Speaking of flows, spot gamma numbers. And I've continued to have people reach out and ask me about these. It is an expensive product, but you get what you pay for, right? And there's levels on here. Yeah, maybe you can find them at other places. I've seen a lot of products over the last 18 months that cover these sort of things. Zero gamma, whether they use, the word zero gamma, they just call it their, gamma level, high gamma, low gamma, whatever. It's the same thing. And you might find it at different prices, but you definitely need a way to gauge where the optionality is in these indexes. Even if you don't trade the indexes, if you're trading Apple or Microsoft or whatever, you're going to want to know when the S&P is about to hit one of these major levels. So, if you're not going to use this one, I don't get anything out of showing this. I'm not affiliated with them. They're not giving me any kickback. If you don't want to use this, use something. And the reason that I show it is I give a good minute and a half to showing these so that you can get your screenshot, because I think they have value. If you want to understand more about them, you can go to YouTube and just type in spot gamma 101, and you'll find this like hour and a half long video, and they go through a little bit in the later part of the video about their product. But in the first half, they're just talking about gamma and deltas and how options affect the broader market. And you kind of get an understanding perhaps of why it has such weight and such value. 4705 is a voodoo line. I did go in and update my voodoo levels. They had a new voodoo update from mid-November. So as soon as I put it on, I could see this level, and I thought, yeah, that makes sense. Yeah, it's right there. So, if it wasn't FOMC today, I'd say this would be a level of concern. But as I just mentioned, none of these levels are going to stop price or interfere with price at all when Powell comes out chipping his teeth. This is a very tight range. This is a classic draw. It's beautiful. I mean, it's textbook. I don't trade things that look like this unless it's something that I can trade options on. And options on futures are fantastic, but not really interested in trying to scalp such a small range with options on the futures. We have a MDP. It's a missed daily pivot. We would have had one yesterday if it wasn't for that exaggerated whip to the downside real quick before we flipped back up. Optionality, baby. You know you love it. So MDP, in all technical terms, this is not an MDP because we hit it, but we wouldn't have hit it if it hadn't have been for the econ, right? So, from an analyst point of view, I'm willing to call that a missed daily pivot. If the volatility from the economic event had not whiplashed us like that, we would not have hit it. And the market continued on as if everything was fine, right? Once it rebalanced the expectations. So this is kind of a gray area in technical analysis. We'll just stick with, the truest sense of the word. It's been hit. So let's just leave it at that. But I encourage you to dig a little deeper on that and consider how you want to approach levels like this, because this is not an everyday occurrence, but it is going to happen in your career, and you need to be able to define, what are you going to do in a situation like this? Do you go ahead and call it hit or not? And then what's the outcome from that? How does it change your technical analysis? The same could be true or could be said about last Friday as well, with that exaggerated wick to the downside. So we have a classic draw here. It sounds like what it is, draw. They're drawing you in. Think about where all the traders are at. Everybody's happy right now. Shorts, longs. If you're short, then your stops would be up here, right? In the classic sense, that's a huge stop. I don't know futures traders that would want to do that, but in the classic sense, your stops would be above this box. If you're short, they'd be below this box if you're long. Which is why every time we get to the edges, we tend to expand just a little bit more and a little bit more and a little bit more. And that causes the megaphone pattern where we start to get this expanding price range. And that's because once we set a high, liquidity is on the other side. So we get there. And then we set that high, liquidity is on the side and we get there, right? Liquidity is always on the other side of the pivot, which makes us expand a little bit farther, a little bit farther, a little bit more. And it just widens and widens until finally we break. And then when we break, we rerun it. The tighter the range, the more draw. The longer it lasts, the bigger the move. There's a cute little phrase that goes with that. I can't quite put my finger on it this morning, but it's a phrase that basically just says what I said. The longer it goes sideways, the bigger the move is when it finally does go. There's no directional bias to that, by the way. So, you wouldn't have a draw or a raid and try to gauge that as an upward move or a downward move. You have to get that data from somewhere else. MDP missed daily pivots almost the entire week so far. It's 4 in a row if you count Friday, and today's not done. So, it sounds great, but putting it into some perspective. The market maker move, we still can't trust. We can go in and look at it, try to gauge this in its relevance to see if it's accurate yet. But as you can see, it's sitting at 40 points, which is huge. And the front end is still not greater than the back end. So I'm going to continue to argue, hey, this is not a market maker move that's true, right? The sad part is, or the bad part, is that I'm sure there is some hedging activity. It's a very tight range. We got Powell, we got all these things today that are kind of pounding the table. They're in there hedging, but we can't see it in our traditional tools because of the OPEX. Triple witch, no less. The ADRs are working, however, and we are in the middle of those. So where are we going to go today? To one of these red lines. Why? Because that's what we do. It's what we have done over the last 20 days, like Groundhog Day, right? Get up, run in a circle, get up, run in a circle. So where are we going? To one of these red lines. Funny enough, we can go to both of those red lines. Get the lower one and then the upper one. 10-day, 30-minute volume profile. As we continue to expand higher, we're not developing that B, capital B. We're still maintaining the lowercase b. If we do stall out at this point and then retrace, say, back to 4650 through this zone, then we could actually start to build out that uppercase B, but no dice yet. It's also very shallow. So when we break this draw, get back inside the zone, we're very likely going to move through there really quick. There's not much at 4680 to help us out. So I wouldn't look at that zone to offer a lot of help. This 5x5 always shines a light on just how tight of a zone that is. That is a fantastic zone. We almost got that VPOC yesterday, but almost doesn't count. And we have a new one now. $46.81 VPOC to the downside. That's 2 new ones back to back. It almost got it yesterday, but we'll keep it. We are 4% above the 10-week still. And we've been this far away before. Not very often, and it doesn't generally last. We can see usually 1 week, right? We get above this 4% for 1 more week, and then something changes. We start to give it back. So we're just about there. I wouldn't try to short today. And really, there's a difference between going short and just not going long. So like a call credit spread wouldn't be out of line. But depending on what Powell says today, we could see 4,800 before the end of the year. Easily. It's only another 100 points. What's 100 points among friends, right? Yeah, it they were talking about that in their founders notes for a couple days, right? That there was a lot of optionality at 4,700, but they didn't roll it right away. Mentor Q did. They had it at 47 all week, but Spot Gamma moved it up. Shoot, I don't know. Was it yesterday? I lose track of who did what and when. But on the SPX, yes, it is 4,700. Mentor Q put it at 4,700 Monday. I moved it. I have to look at their email, but yeah, it's 4,700. There was a lot of optionality there earlier in the week, but it hadn't reached a level yet to I don't know, qualify isn't the right word, but to be marked out. We are a little extended past the 10-day. It's not extreme yet. It's just a little bit, but I mean, it's a little untenable. Let's run it back. So 10-week, we're at 4%. By next week, a call credit spread is probably not a bad idea, but I want to see how FOMC goes. And for the 10-day, we're 1% away from the 10-day. 1% is not bad. You can see we've obviously been higher than that before. So, it's not like we haven't been here. This is not overbought. It doesn't owe us a it doesn't owe us a pullback or a pause at this level, but it should make us start to think about how much harder the market's got to work when we're already 1% above the 10-day. In a short duration trade, we could easily expend another 1% higher. Easily. Look at the zone for the week. We're still within the weekly expected move, which is nice. It's a cog line, 47.11. And I don't want you to think that it's not worth the effort to lay out your pivots today. I know I said that FOMC is going to run them over, but you still want them, right? Because there's a long time between now and 2 o'clock. More than half of the trading day is done already, right? We're on the downhill slope, but between now and 2 o'clock, you're still going to want those levels. So yesterday's half back, high-low close, they still have weight, they still have value, and then add in, whatever you got, voodoo lines, spot gamma levels. We're really far away from that zero gamma and the volatility trigger. And when we're that far away, we don't expect big move days. You can see all the short covering that's really ripped us to the upside. So there's morning briefings like this are they're kind of sneaky, right? it doesn't feel like there's much of a reason to go in and dig through what is up. There are things that are moving. There's always something moving. But I'm a bit picky in what I trade. And so, generally the things that I trade are going to be affected by the indexes. And if the indexes are paused and stagnant, then so are the things that I want to trade. This is something that has been getting more traction lately. So I like to kind of bring it up from time to time that especially if you're a futures trader, there is more to life than just trading the ES. I know, shocking. Blasphemy. But really consider, trading gold or oil, just for an example. Oftentimes when I can't see anything reasonable or decent to trade in the ES or the NASDAQ, I trade oil or gold. And there's micros for both of those. So it's not like you got to take on, the full contract. There's even nano products if you're interested in trading things like Bitcoin. There's that Bloomberg series. So, you can get your risk down to like 10 cents because that nano is super tiny. That won't even cover the taxes on your coffee at a McDonald's. All right, so there is always something to trade. Take a look around on a day like this where maybe things just aren't moving all that much. And I don't know, see what else is out there. Don't get married to one product. Options on the futures are something we're going to be hitting on more and more next year. They don't trade exactly the same as in equities do, and you have to do a little math to figure out because it's not 100 shares kind of math. It uses the ticks and the points, but it's worth it. I figure it's worth talking about this morning because it's not like we can go in and look at much on the equity side of things. So when it comes to the index options on the futures, just think about the ES versus the SPX versus the SPY. All right, so you want to sell a put in the spiders. Well, you need like $50,000. You want to sell a put in the SPX, and I'm talking naked, right? Naked options. You need what, $150,000, $200,000. You can sell a put on the MES for less than a $5,000 account, which is awesome. You can do it in the ES, depending on the contract that you pick, for less than $15,000. Naked options can be defended easier. So it's no longer a binary trade of, well, I'm going to win or I'm going to lose. How about I'm going to win or I'm going to win less? That sounds better than I'm going to lose. They're more easily defended. And there is premium a long ways from the money, as opposed to, say, SPY. You get $5 away, there's really no premium left. Unfortunately, most brokers aren't going to let you do complex positioning. So you're not going to do like butterflies and condors on futures options. You have to leg into each leg. But you can see I'm looking at, this is the ES at 4,700 this morning. We can go out to 4,300. Come on, man, that's 400 points away. And there's still premium out here. It's not, fantastic premium. You're not going to make a mortgage payment with it, but there is premium even that far away. So what does it mean when I sell a put, the 4,300? It means that I think price will be above 4,300 at expiration. So you look at a weekly chart, 4,300 underneath that 50-week moving average, and ask that question. You think we're going to go to 4,300 between now and Christmas? Nah, no. How about by the end of January? That's the bet that you're placing. So, what about 5,000? Do you think the S&P is going to be at 5,000 by the end of January? Sell a call at the 5,000 strike. Simple as that. So in the new year, we're probably going to get into more of that. Got access yesterday to quick strike futures options data. It's a massive database of, got to crawl through it, figure it out a little bit, but it should solve a lot of the unknowns, right? When it comes to the drag when we swap contracts and from like we just did, right? When we went from the December contracts to the March contracts in the futures. Well, how does that affect the optionality? And can we use that? All kinds of really great stuff. For today, though, it's just the clock, right? Watch the clock. Watch the clock. It's boring. I know it's going to be a boring morning. I know many traders who take the entire FOMC week. They just take off that week. It's where they get their vacations and get their honey-do list done. Not a bad idea, really, in the grand scheme of things. But if you don't need to trade this week, you probably don't want to trade this week. So we got the Dixie here, the DXY dollar index. And, there's been a number of analysts who have called a top in this thing. They said we're done. That's it. That doesn't mean we're just going to fall like a brick. There's going to be some runs to the upside. But if the top is in, that has a lot of impact to our market in general. It's worth looking into, especially if you're not trading because you're waiting on FOMC. Kind of doing some research on what does that mean? How did it affect us back in the 07, 08 when the dollar finally topped? Or, back in, I don't know, pick your crisis, right? The December 2018 Christmas save or Volmageddon. There's enough events in history to kind of lay out what we could do with a dollar that's topped out. We got the 10-year sitting on the 200-day moving average. Kind of rested it the other day. Has been a sharp, very clean move to the downside. Looking for a little bit of mean reversion here in the short term. I'd say as long as we stay below the halfback, then we want to continue to focus on this going down or staying down. There's a lot of reasons to believe that we're still going to see, more than 5, right? This top that we put in. But we're under some key levels right now, and we're resting on some pretty key levels. So historically, this is likely to chop about now for, at the bare minimum, a year. We've got our range set between, say, 3.4 and 5%. So we could just chop about here for another year or two, which just sounds exhausting. Beyond FOMC, I think the next big threat to the market is Japan. If they do change their programming over there, the ramifications to that are unimaginable. So we got some pot stocks this morning that are up. Uranium, energy, and that's about it. And some biotechnology. It's enough, right? There's always something. I see these pot stocks. Yeah, not really exciting, huh? I'll take what we can get. OGI. Yeah, that doesn't look good. SNDL. Penny stock trash. And Cron. So uranium's up this morning, but there's no flow behind it, right? They're just notches here. So uranium, has been turning around. It's looking great. There's a lot of reasons for why uranium continues to be a long-term trade. A lot of reasons. This thing is not done. It's not going away. But these prints this morning, there's no volume to them, right? There's no real flow to them. Now, oil fell out of bed this week. Our halfback level right now is $70.08. A little bit of buying activity along these lows. See the wicks from yesterday and today. That halfback level is your area of interest. The thing is, you're better off taking the long from as close to the low as you can get, even though it's not confirmed as a long, right? I know that it's the most uncomfortable trade you can get, but I do like that phrase that says, if your trade feels good when you got in, you're probably doing it wrong, right? It's not supposed to feel good. Usually the worst position, so it seems at the time, is often the best entry you could get, going long from the low of yesterday, for an example. But there's no signal to go long from the low of yesterday. You have to take it just knowing that that's a reversal point. Either way, getting in before the breakout or the breakthrough, the halfback, would be your least amount of risk, because your proverbial stop would be down here at $68. If you do want to wait for confirmation, then getting through 70 and then coming back and resting against it like a Busby play, finding support off of old resistance would be a good shot. So above 70, long above 70, with 72 as the target and the first area of interest. You can see this selling, and we don't know if they're done, right? It's 3 levels of selling, 3 days. And even above that, I've got this channel here. So it would be a fight above 72. But if you got a good enough entry and you're able to roll up, lock in your gains and get risk out, then you're able to hold the trade anyways and see how much more you can get. Just be careful. This is in a full-on downtrend. So, you could get an upside play. You can see 3 bars here, 2 here, 3 here. It has, given that upside move, but we're not talking trend reversal at this point. We've got to break some key levels before we can start considering this a long-term swing back up into the high 80s and 90s. We're nowhere near that point yet. GLD or gold up a little bit in the pre-market with US dollar Japan being flat, basically. And nat gas continues to just brutally move to the downside. It isn't cold enough from their projections. They were expecting a colder winter, and so far, knock on wood, it hasn't been. Then there's that whole issue with the there's just a lot here. There's a lot to unpack. I wouldn't try to bottom fish this. I wouldn't mess with it unless it's your niche. So we got a gap up in Microsoft. Reasonably decent pattern. We've broke the box, so you can just measure the box and project it upward. A couple of different ways to do this. You just take the whole thing, or you can just grab the biggest candle in the zone. You'll know that you measured it right because your lines will line up, right? I'm a little high on this. So looking at this, I could remove that doji, see if that gets me a better outcome, but now I'm too short. I'd rather be long than short. So I'm going to put it back. You never know, right? Just check. See which one of these lines up better. If we did use the full candle here, and then we just add the levels. Two and a half gets us there. And it sticks to the logic that we would normally use anyways, measuring the biggest candle or the dominant candle in the group. If we start from our current location and go back to the first candle of size, that would be here. But if we take the whole of the group and the start of the strong candle, that would be where I'm at. $376.80 lines us up with the open of this day. It's pretty close to where we are this morning on Microsoft with this gap up. There's a lot of gaps that need filled. We filled this one yesterday, or if we didn't, we came really close to it right at the end of the day. Do some OCR analysis on this one. You see the recovery day, and with almost no wick, a slight gap down, and then just a straight burst to the upside, closed at the upper part of the day, and now we're gapped up. That's a really nice recovery move. The problem is this was a really nice recovery play too, right? You had the flip and then a big gap down and another rally up, closed in the upper part of the day, opened, gapped up, and then just dumped. So there's a lot of reasons not to trust Microsoft right now. Still, we are continuing to get these higher lows. And this morning, you know, we're gonna hit this pivot. There's another gap to close up here. $378.91. And above that, 380.87. If we do fade back this morning, not at FOMC when he's talking and everything gets all wonky and it's bouncing around, but just in the regular course of price movement today, we need to hold above this 376, 373.60. And at the end of the week, the close this week, we need to stay above that level. It's been a fight. I picked on Microsoft because it was the one that was up the most, but Google's right behind it. And so is Apple and Snow. Remember the Snow is in the fangs, the NY Fang. And so is Broadcom now. It replaced AMD. So if we get the fangs running this morning, we could see a little bit of a grind higher in the NASDAQ while we're waiting on FOMC. Watch out for PPI. It's coming in 15 minutes, and then just watch the clock, guys. Be careful, be safe, have a good day. I'll see you all tomorrow.